Everyone is wrong about what happens next. Every 4 years, it happens. September shows up, and suddenly the bottom falls out of the crypto market. Bitcoin stumbles, altcoins bleed, and the comment sections fill with doom and gloom. Headlines scream that the bull run is finished. But here's what almost everyone misses. September has never been the end. It's always been the shakeout, the flush, the reset before the biggest moves of the cycle. And what comes next, if history is any guide, is explosive. October, November, and December have consistently delivered some of the strongest returns in Bitcoin's history. And this time, the setup is even more powerful. Because this cycle isn't just about retail hype, it's about ETFs, corporate treasuries, and institutional demand on a scale we've never seen before. So in today's video, we're going to break down the September crash history, look at where we are right now, explain why Q4 has been the best 3-month stretch of the cycle, and show why, this time, it's fundamentally different. Before we dive in, most people watching aren't subscribed. If you find value in these breakdowns, hit that subscribe button. It's free. It helps the channel grow, and you can always change your mind later. Let's rewind to the past 3 blow-off top years. In 2013, the September correction kicked off almost instantly, right at the turn of the month. Bitcoin lost about 15% in just 2 weeks. Alts, as usual, dropped harder. But by early October, the leverage had been flushed and the market was ready to climb again. 2017 was even harsher. The crash began on September 2nd and ran for 2 weeks. Bitcoin lost 40% of its value. That kind of move obliterated altcoins. Many lost half the value or more. But once the pain was over, the stage was set for the vertical run that carried Bitcoin from under $5,000 to nearly $20,000 before the year's end. 2021 had its own twist. September actually started with a rally. Confidence was high, traders were greedy, and then on September 7th, the rug got pulled. Within 2 weeks, Bitcoin was down 25%. Altcoins got crushed. But again, by October, Bitcoin had stabilized and ripped 43% higher in a single month, straight to new all-time highs. The pattern is undeniable. In post-halving years, September is almost always red. It's the month that clears the table, shaking out leverage, killing overconfidence, and convincing half the market the run is done. And then almost like clockwork, Q4 delivers fireworks. Fast forward to today, 2025. The halving is behind us. Bitcoin has already broken into 6 figures. And once again, September is living up to its reputation. We've seen sharp pullbacks, brutal red candles, and sentiment swing overnight. Comment sections are filled with panic, just like they were in 2013, 2017, and 2021. But step back and the picture looks different. This isn't exhaustion, it's a reset. Bitcoin ran hot into late summer. A pullback here isn't unusual. In fact, it's textbook. And like prior cycles, most of the damage happens in a handful of days. 1 or 2 massive red candles, maybe a liquidation cascade, and the market stabilizes. That stabilization is what matters, because once Bitcoin finds its footing, history says the next stage of the cycle almost always kicks off in October, November, and December. Let's talk about Q4 performance, because it isn't just a coincidence, it's one of the most reliable patterns in all of crypto. Back in 2017, September was brutal. Bitcoin lost 40% of its value in just 2 weeks. Everyone thought the run was over. But by October, the market had flipped on a dime. Over the next 3 months, Bitcoin didn't just recover, it doubled. Ethereum went even further, going parabolic as retail money flooded back in. That stretch didn't just make headlines, it minted fortunes and cemented crypto into the mainstream. Fast forward to 2021. Once again, September did its thing. Confidence collapsed, red candles stacked up, and traders swore the bull run was finished. And yet, October delivered a single-month gain of 43% for Bitcoin. Ethereum ripped even harder, leading the charge into November before the final peak. The lesson? September was just a shakeout. The real move came right after. And these aren't random outliers, they're part of the rhythm of the 4-year cycle. September clears the table. October, November, December, that's the feast. But remember, it's never a smooth lineup. There's always volatility, always noise, always headlines designed to scare you out. But time and time again, the final quarter of the year has been the strongest window of the entire bull run. Which brings us to 2025. Once again, September has lived up to its reputation. But if history rhymes, and it usually does, the fourth quarter could be the window where this cycle truly delivers. And here's the twist. Unlike 2017 or 2021, this time it's not just retail FOMO driving the bus, it's ETFs, it's corporate treasuries, it's institutional demand, a brand new engine under the hood. In 2013 and 2017, the market was almost entirely retail. A few crypto-native funds, a handful of whales, and millions of small traders chasing the dream. In 2021, institutions dipped their toes in, but the real floodgates never opened. Now, it's different, and it comes down to two words: ETFs and treasuries. Bought Bitcoin. ETFs have rewritten the demand side of the market. Billions have poured in through regulated, trusted channels. Advisors, pensions, and family offices now have a simple way to allocate, and they're doing it quietly, steadily, without the noise of retail hype. But here's the kicker. Recently, the Ethereum ETFs have been outperforming the Bitcoin ETFs. That tells you where institutional appetite is heading. And later this year, we could even see Solana and XRP ETFs hit the market. Something unthinkable just a cycle ago. Then there are corporate treasuries. MicroStrategy wrote the playbook: raise capital, buy Bitcoin, and use the flywheel of higher valuations to raise more. But now that model is expanding. We're seeing companies not only build Bitcoin treasuries, but also Ethereum treasuries, and even allocations into Solana and XRP. This isn't hype-driven demand. It's balance sheet-driven, strategic, and sticky, and it fundamentally changes the structure of the market. On top of that, crypto is becoming collateral. Bitcoin-backed mortgages, Bitcoin-backed loans, even US cities experimenting with Bitcoin mining as part of their financial strategy. When assets make the jump from speculation to collateral, people stop treating them as trades and start treating them as money. That shift builds higher and higher floors under price. So while September might still bring its familiar shakeout, the recovery this time has deeper fuel. Institutional demand doesn't panic sell on a 5% red candle. Treasuries don't liquidate because of one ugly CPI print. These buyers are bigger, slower, and stickier, which means when the next leg higher begins, the base is stronger than ever before. The other piece of the puzzle is rotation. Every single cycle, once Bitcoin finds its footing, the market starts to shift. Ethereum begins to outperform. The ETH/BTC chart turns up. And that rotation sets off the chain reaction we've seen time and time again. Capital moving down the risk curve. We're already seeing the early signs. Ethereum looks undervalued relative to Bitcoin on the charts, but now it has a catalyst we've never had before: ETFs and treasuries. The Ethereum ETFs that launched last year have been pulling in stronger flows than Bitcoin ETFs. That tells you institutions aren't just comfortable with Ethereum, they prefer it. And it's not just me saying this. Wall Street veteran Tom Lee has laid it out clearly.
Wall Street now is going to be building its entire infrastructure onto the blockchain. And the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity. This is not going to be a popular statement because there's a lot of tribalism in crypto. But before this year, I would have considered Ethereum like a really good, reliable chain, but without any products being built on it, it shouldn't really do well. But because of what's happening with AI and with Wall Street and, Project Crypto, I think Ethereum's essentially the value of its protocol layer, like, Union Square Ventures calls it the FAT protocol, is now going to be more valuable because we're tokenizing everything on Ethereum rather than just gold. So if gold is a $21 trillion market, tokenizing the real world is orders of magnitude larger than gold, which means Ethereum probably will flip in network value versus Bitcoin.
That shift changes everything. Once ETH gains momentum, it rarely just catches Bitcoin. It often outpaces it. And when that happens, the door swings wide for the next stage, selective altcoins. Now, this isn't 2017 where everything pumps. The days of every random token flying simply because Bitcoin is running are gone. Liquidity is deeper now. The market is more mature and investors are smarter about where they deploy. But the altcoins that do catch the bid, the ones with real adoption, real ecosystems, or even emerging treasury demand, those can still deliver extraordinary moves. And that's another reason this cycle is unique. For the first time, altcoins aren't just pure speculation. Some are being treated as legitimate treasury assets. Companies are raising capital and deliberately allocating not just into Bitcoin, not just into Ethereum, but into Solana, XRP, and beyond. That kind of allocation adds legitimacy, it creates sticky demand that doesn't vanish on a red candle, and it means when capital rotates this time, it's rotating into assets that are actually being integrated into balance sheets and financial strategies, not just meme tokens riding a wave of hype. The takeaway is simple. Bitcoin leads, Ethereum follows and often overtakes, and then altcoins get their moment. But this time, the rotation is underpinned by institutional flows and treasury adoption. That's not just a hype cycle, that's structural demand. And it could make the altcoin phase of this cycle stronger, sharper, and more surprising than anyone expects. None of this means September will be painless. It never is. We could still see another 10 to 20% correction, especially if macro headlines pile on. A couple of huge red days can still shake confidence, just like they always have. But the real risk isn't the pullback itself, it's missing the recovery that comes after. Missing the window where October through December deliver the biggest moves of the entire cycle. That's why discipline matters more than timing. You don't need to predict the exact bottom to benefit. You just need to understand the structure. September is usually the flush. Q4 is the liftoff. And this time, the liftoff is powered not just by retail FOMO, but by institutional rails, ETFs, and corporate treasuries that make this cycle unlike anything before it. So here's the big picture. September is red. It almost always is. But history says that's not the end. It's the beginning. October, November, and December have consistently been the strongest stretch of the entire cycle. And this year, that setup is colliding with a fundamentally stronger demand base. ETFs, corporate treasuries, institutional rails, and collateral use cases that didn't exist in past cycles. That's why this cycle is different. That's why the Q4 window could deliver moves that shock even veteran investors. Shakeouts come and go, but the structure remains, and the structure is pointing toward a fourth quarter that could define the entire bull market. If you've made it this far, you're clearly serious about crypto. So do yourself one favor. Hit the first link in the description and subscribe to Crypto Nutshell, our free daily email. We write it every morning. It takes 5 minutes max to read, and we cover the biggest stories, the sharpest predictions, and the on-chain data that actually matters, delivered before the market opens. It's fast, it's free, and it keeps you ahead of the curve. Thanks for watching. I'll see you in the next one.